Hello there, and welcome back to Elements in Focus. Grant Soliven, Manager Advisor Operations. Always with me, Director of Financial Planning, Aaron Rheaume, and we are so grateful to have you back on the show. Today, we're going to be hitting Investment Playbook. For those of you that are new to our program, what Aaron and I do here at Elements of Focus is take all of our 5 critical elements and try to go through and give you little snack bites of planning information that you can use in your situation today, or that hopefully will help you kind of avoid some of the devastating roadblocks that we've seen families hit along the way. One thing I will state here, one thing that Aaron and I always want to make clear, Aaron and I do not cover a lot of the actual investment pieces, so what stock to buy, what's going on in portfolios, et cetera, what's going on macroly in the investment world or with technical analysis. We leave that up to our Chief Investment Officer and one of our portfolio managers, Andrew Thrasher and Adam Harder. That video comes out every Thursday, actually. It's called The Market Carver. So please don't forget to tune in there. They do a phenomenal job of walking through what's going on in the investment world and the economic world every week in that video. Don't miss out. But going to our investment playbook, we're going to take a little bit of a unique turn in today and cover the phases of finance. And Aaron, why are phases of finance important, and why are they in the investment playbook section?
Yeah, great question. There are 3 of them. You have the accumulation phase, you have preservation, and then distribution. And we relay that to a flight. So the accumulation phase is where you're really taking off and starting to get the plane off the ground and head up into the air. Preservation is where you're 30,000 feet, above the clouds, looking over the world and just taking that plane ride to your destination. And then distribution is landing the plane at your destination. And so to break those 3 down, accumulation, there's 2 really important things to make sure you're doing inside of that. One is building tax diversification through different types of accounts. So you have IRAs, which are tax deferred. You've got Roth IRAs, tax free, and brokerage accounts or investment accounts that are taxable, meaning that if you have dividends, interest, capital gains, you get a tax form that year and pay taxes that year. So making sure you're saving the right percentage of your income and building tax diversification. Preservation is, again, that 30,000 foot view. At this point in the phase of finance, the assets that you have accumulated are more meaningful than the dollars that you're contributing to your accounts, and so you're preserving those over time. This is the only time average return matters, and the other focus point there is making sure you're paying down liabilities, so when you move into the distribution phase of finance, and that's landing the plane, retirement planning, your life after work, 2 critical factors there are managing volatility and the average tax dollars that you're paying on distribution. And so managing the volatility between your distribution points, because you're taking money out of your accounts to maintain your standard of living, and making sure that you're having an efficient tax plan going through the distribution phase.
And something I'm going to add on to Aaron, and wonderful job explaining that, very well done, is that you'll notice in all 3 of those three of those phases, Aaron didn't say maximize the amount of return possible, right? And that's the key element we're trying to get through. In accumulation, return matters, but it's 3 to the first 2 most important critical ones, right? We're not saying don't go get any, don't let cash sit, or don't let some money lose to inflation, but you understanding your investments is a key piece, but not the most critical. In preservation, again, not obtaining the most return humanly possible. What was it? Protecting the nest egg you've created, and providing due diligence and correct asset management to make sure that plane gets you to your destination. And finally, the most important, where families ask us, Aaron, well, I need to get the most return possible so I can retire. It's not how it works, because Aaron and I can show you this little problem in our system called sequence of returns, where you can have an average rate of return of 10% on $1 million portfolio and be broke in 10 years. Yes, that actually can happen. It's called sequence of returns. And so making sure, like Aaron stated, you control the points of volatility at distributions is absolutely key.
And taxes.
And taxes. Because remember, taxes is the number 1 wealth eroder in our financial system today. So Aaron, well done on presenting that. Thank you for the time there. So a couple key pieces here as we wrap up. Don't forget, if you've not met with our team already, schedule that complimentary meeting. That next steps meeting can be an hour to an hour and a half long, where we really dive into your situation. It's about you and give you critical things to think about today things to consider tomorrow, and if we do partner together, a written plan that we'll continually monitor and adjust over time together. If that's something that you want to kind of go through and adjust those critical or evaluate those phases of finance, please call 800-928-4001. Connect with Brittany. She'll get you scheduled with one of our qualified team members. You can also scan the QR code. And if you have any final questions, shoot them to us at talktofeg@yourlifeafterwork.com. We'd love to get you an answer. Thank you for your time today again. We'll see you at the next one.